variation while N. Chandra has been in charge.
Sure.
Tata Tech is the only stock that has actually lost ground.
Okay. All right. Shares of Shriji Shipping Global and Patel Retail also in focus as their 6-month shareholder lock-in periods end today. Jasmeet joins in with more details.
Well, right, very good morning and thank you for that. I have a couple of stocks that will be in focus on the back of the lock-in expiry. The first one is Shriji Shipping. While this company remains in focus on the back of the 6-month lock-in expiry which is ending today, as many as 10 million shares will exit the lock-in period at 6% total equity. While the second stock that will be in focus on a similar regards is Patel Retail. As many as 17 million shares will be freed up in trade today at roughly 51% of total equity. So this will be focused on the similar regards.
Okay. All right. That's a little bit of news coming in. But since we were talking about the Tata Group, CLSA on TCS has maintained an outperform with a 3,593 rupee target price. That's an upside, a 29% upside. They're saying it's business as usual for service integrators. Narratives aside, SaaS implementation remains key growth drivers. TCS partners ServiceNow to accelerate AI adoption, highlighting the continuing role of service integrators. ServiceNow has grown 20.5% year-on-year in constant currency terms in FY25, implying similar growth for for SIs around SaaS implementation. Tech M has the strongest ServiceNow capabilities across Indian and global peers. They have built in 35 rupee dividend in Q4 and possibility of buyback over the next few quarters given recent changes in the budget. So I thought that was an important one to note as we start looking at what IT is doing when we start trade. And you have the pre-open rates which are now streaming in, the first cut really of pre-open rates. And let's just pull up what is moving this morning. I mean, look at Vari Energies and Premier Energies. We really hope to speak with Vari Energies and Premier Energies. We want to understand how this impacts. We're talking about, what is it, 126% duty?
Yeah.
Okay, 126. We've come to that stage where the numbers just no longer
sense.
matter. And like I said, the heart really goes out to people in the business of exporting to the US and selling in the US. I mean, what do you even say? Premier Energies, Vari Energies, I want to talk about.
First of all, Premier does not export to US, by the way.
But Premier Energies
Vari is 50% of the order book is from US and 20% of current supply is to US. But Premier does not supply to US.
So Premier,
I don't hold the stock, I'm just...
No. So I don't know why Premier is maybe just with the flow, getting a bit bashed up. Correct. But remember, these are the first couple of minutes of the pre-open session. IRFC, that OFS doesn't seem to be going too well either. Just looking at any trends, early trends that we can spot for you guys. Bharti Hexacom is doing okay. Central Bank, Union Bank looking interesting. So is Coforge seeing a bit of a rebound. We'll watch out for the tech stocks. Birlasoft is also doing okay. Chandan Taparia joining in now, Head Technical and Derivatives Research at MOFSL. Chandan, very good morning to you. Is today the day of recovery?
Good morning, Tamanna. Thanks for having me. So the interesting part for the market is it witnessed selling pressure on its monthly expiry day. But in multiple times in last 15 days, index managed to close about 25,400 marks. So we are near a key support of 25,380, 25,400 marks, but recovery is very important. And in last couple of days when Bank Nifty was holding well, Nifty IT was laggards with sustained selling pressure. So if market manages to find some recovery, then I believe it can give some up move to the broader headline index as of now. So I believe that with the support of 25,327, which was the penny low made on the expiry day, could act as a key level, and because of that it might see recovery towards 25,650 levels. So we'll look at some recovery, but we need to look at the follow-up activity. But at the same time, I believe counter from banking, power and selective financial counter could do well in this market scenario.
Okay. All right. We talk about individual stocks, and Chandan, good morning to you. What are you liking this morning?
Yeah, good morning. So we will focus on the Nifty Power and Energy Index. We are expecting most of the power company to witness good recovery and momentum from current level, whether we are talking about NTPC, Power Grid or Tata Power. And here I would like to select on the NTPC, looking for 10 to 15% kind of rally on the positional point of view as per its price pattern on the daily, weekly and the monthly chart. But on immediate point of view, we are recommending to buy the counter with support of 374 and it can head towards 400 level. Talking about price structure, it has been making high top, high bottom, respecting well above its rising support trend line. We have seen rollover of long position from the previous series to the current March series. So this counter can head on higher side. Second trading idea, there is buy on Astral. Good price action has been making higher tops, higher bottom on the weekly chart. It has given a decisive breakout above 1600. So up move could be seen led by its consolidation breakout. One can buy with support of 1630, and this counter can head towards 1725 kind of levels.
Chandan, would you look at any IT stocks this morning?
So it's very tough to comment on the IT because most of the counters are deep into the deep oversold territory. So technically the structure is weak. The only good part is risk reward ratio is quite favorable. So if I have to pick one name, I'll focus on the heavyweights, and I think it can be counter like Infosys or TCS, where some support based buying is there. Already we have seen short covering or short unwinding. So with support of 1250, I think Infosys can recover to us 1320 kind of level. In TCS, I'll closely watch the surpass of 2600 level. If that happens, unwinding or short covering can take it to a 1650 to 1680 kind of levels.
Okay, stay on with us, Chandan. Let's get to our big brokerage call of the morning. Macquarie has maintained an underperform on Swiggy and Zomato. Puni joining in to tell us why.
Well, likely, and it's continuing their view on being bearish on this particular space, Tamanna, and it continues to say that the current valuation of the food delivery business for both companies is 30 to 35% more than what the consensus sees. So they are continuing with the view that Swiggy currently, of course, trails Zomato by almost 150 basis points for the net take rates. Now, this is of course from what they get per order, but they've specifically also mentioned that since it's a duopoly, there seems to be no take rate deflation, so it's likely to be maintained at these levels. But they've said that the margins are just 6 and 5% respectively for both players don't justify the valuations that is given to this particular vertical at this point of time. Roughly around 12 to $14 billion valuation is what the street is currently given Zomato on its food delivery business, and they feel that the fair value is 30 to 35% below the consensus estimates that's given right now. So continuing its bearish note and bearish view essentially on the food delivery space at a time where Zomato has started or Eternal has started to see correction in stock prices. So that's some Macquarie's key view on it. Likely a lot more pressure going forward is what they are anticipating.
Okay. Swiggy and Zomato, Swiggy at least looking buoyant in the pre-open session, as is Eternal at this point. So not too much pain there. Hindalco is really what is catching my eye. Hindalco in focus. TCS, we talked to you about that CLSA note about percent up. HCL Tech, Infosys. These are some of the nifty hitters that are moving this morning, and you might see a further upside. We talked to you about Power Grid, and that also is seeing some action at this point. I know, Paragwa, you've been very constructive on IT overall, but are there any fresh positions you would build when you're seeing this kind of uptick?
Yeah, so Infosys and Techem, very clear ones. Mainly Infosys. I think Infosys has fallen too much. This Entropic itself has tied up with Infosys, which shows that it is not completely obsolete, and 16 times P and 4.5% dividend yield. So I would go with Infosys in IT pack. And of course, in FMCG, I would like to say that the king of FMCG, HUL, also looks actually very good. I think under Mrs. Priya Nair, who is the new CEO, I think the company is doing all good steps. After a long time, they have announced a 2,000 crore capex into beauty and wellness segment. So I think and Q3 also, in spite of GST problem, like November there was a destocking, so still they showed 4% volume growth. So I think Q4 and FY27 is looking much better. And plus, why I prefer FMCG most is that it is not affected by any technology disruption.
It's a safe play to look at from a domestic market perspective,
yeah,
right?
And no disruption, right? So.
Okay, so no disruption when it comes to consumption. Schaeffler is another one. Smart moves coming in on that one on the back of Q3 numbers. Apart from that, you have Vedanta also, which has a board meeting today to consider a fundraise. And ahead of that, that stock is seeing some gains of 1.5% in pre-open. What are charts indicating, Kush? Any trade on a Schaeffler and a Vedanta?
Oh no, I think there is perhaps going to be a good gap up opening of about 4.5-5% on Schaeffler, puts it at the resistance level of 40 to 75, 4,300. This is the time when you go out and book profits if you held it from a near-term perspective for sure. Vedanta is something that you can still consider. It's got a good support zone near the 20-day moving average of 685. Immediate resistance at 705. So if it opens above that and sustains above that, then I think it can have a good clear run to 720 and about 735 odd levels. So between the two, if I were to pick, Vedanta right now slightly better placed.
Okay, we were talking about Hindalco. What's happened is that their arm Novelis has entered a subscription agreement with AV Minerals and issued 13.33 lakh new shares to AV Minerals. So the parent firm has invested nearly $200 million into Novelis. It's no change in ownership. It's an intra-group transaction. But it is being seen as positive because the funds are critical for bridging liquidity pressures caused by two major fires at the Oswego facility in the US. So it's more of a fund infusion when you're looking at. We spoke about metals a short while ago. Is Hindalco shining for you?
Yeah. So basically, as I said, it is just to bridge that temporary liquidity gap. So whenever that liquidity gap gets addressed due to higher EBITDA of Novelis, they will take that money back. That is my understanding of So because they don't want the net debt to equity to blow up significantly.
So it is basically borrowing from a friendly cousin.
Correct.
Okay, correct. Sometimes that's the best. It's all in the family. Chandan, you like Hindalco on the charts?
Yes, I think some recovery should be there from lower levels. In fact, a couple of metal counters are finding support near its rising support trend line. So with support of 905, I believe it can head towards 950, 955 levels.
Okay, 950, 955 levels. What would you do with a Vari or a Premier Energies today? They're going to have a tough start, but we are going to be possibly hoping to speak with one of these companies and just understand what those pain points are. I mean, they've ended the pre-open session at a 10% down circuit. If there is a recovery, would you buy into it, Chandan, on Vari and Premier?
So I think better to wait and watch, let the stability happen, because there are other pockets in this market which are comparatively having the better price placement. But looking at the technical setup, I believe 2850 could be a key level. If that is broken, then I'll avoid. Otherwise, 2850 can give some stance for support is buying.
I want to talk to you about some of these heavyweights on the benchmark, right? So in trade yesterday, you saw weakness in HDFC Bank, you saw weakness in ICICI Bank, Larsen and Toubro. And there was one more, right? So would there be support from these Reliance Industries that throw that into the mix? It saw quite a bit of volatility in trade yesterday, relatively speaking.
True. Not too worried about Larsen and Toubro, honestly, because it's had a good run. Yesterday, you saw a fall on the back of good volumes, but that could just well be profit booking. So the stock's actually gone up about, about from 3,700 odd levels to all the way 4,400 odd levels. So some profit booking. So medium-term trajectory, near-term trajectory, all positive for Larsen and Toubro. So in fact, any kind of declines, I'll take this as an opportunity to go long. My concern is largely around HDFC Bank and ICICI Bank that I've been speaking for the last, 8-10 sessions, where they've not gone anywhere. So I think consolidation could still continue. The only thing that could perhaps change, at least from a technical standpoint, is FII buying, returning, and then, these stocks finding favor. If not, then I think this consolidation could well continue. 900, 890, good support zones for HDFC Bank that should be respected. And ICICI Bank has been holding on to the 1735, 780 levels. As long as these levels are maintained, I think the consolidation that's going on in these names could continue, but no immediate uptrend triggers, at least on, the volumes and price action, candles.
Okay. One other stock that we want to address right now is Dr. Reddy's that we have pointed out as well. Clearly, Novo Nordisk is going ahead and cutting the US list prices of its blockbuster drug by up to 50%. This will be effective 1st January next year, and they may opt for similar price cuts in Canada and Brazil as well. Now, what happens on this news is that DRL has plans with regards to GLP-1 category in Canada. They aim to launch the generic version of semaglutide in Canada once Health Canada clears its file. So if Novo Nordisk goes ahead and cuts prices, it will be a major pricing pressure point for Dr. Reddy's as well, and that's the reason probably why you're seeing that 1.5% cut. A quick view, in terms of charts as well, Kush, on DRL.
So it's had a good 4-week uptrend, but it's not been able to sustain at higher levels. So be a little cautious on Dr. Reddy's. Lupin is something that I prefer over Dr. Reddy's at the moment.
Okay, Parag, quick point.
Yeah, so I would agree with Kush. Dr. Reddy might have a slightly, I would say, dull Q4, while Lupin earning momentum continues.
You know, this is the problem with getting your timing wrong. Dr. Reddy's was one of the first Indian companies to jump on the GLP-1 bandwagon, but it was just not quick enough. Because by that time, that whole cycle of others coming in, now generics coming in, and the rate cuts have played out. So I wonder if that happens also with companies who are trying to scramble onto AI. You just have to get your timing right at that minute. Otherwise, you miss the bus one way or the other. Well, we have our timing right. Just about 10 seconds to go before markets open this morning, this Wednesday morning. Is it going to be a bit of a breather? It's been a walloping for investors the last couple of days on the street. We could do with some green on the screen. And luckily, that's how we're opening out. About 90 points up as we open, over 100 points up. All right, that's some strength that has been missing for a while. So this is really heartening to see, about 0.5% up. What's helping is now brokerages having a change of heart. You have a couple of them, Nomura, if I'm not mistaken, and CLSA, who are coming and seeing IT stocks with slightly rosier tinted glasses, and that's possibly what's helping. Advanced decline ratio is also robust this morning. Bank Nifty is looking okay. Broader markets all in the 0.5% range here and there. I want to look at Nifty IT. Is Nifty IT going to be the star of the morning? We've seen the Bank Nifty is okay, but let's look at Nifty IT. Yes, it is nearly 3% up. There you go. So you are having that sharp recovery coming in. Yes, there are technical levels which also support that, because after a point it's an oversold territory, really beaten down. And you know, I can already see Parag Thakkar smile from the corner of my eye. We'll get his inputs in a bit from now. But let me pull up the Nifty heat map for you. And of course, you'll have the IT pack dominating the top line as is expected. Tech Mahindra 3% up, HCL Tech, TCS, Infosys, Wipro, all of them shining. Geofin doing okay, NTPC. Power Grid, we told you this story. More spends coming in and some of those allowances going up for Power Grid. That's positive. DRL, have they mistimed their big GLP-1 move? Because the leaders have come in and now have decided to slash their prices. There's actually an oversupply of weight loss drugs. Are there enough people to go on them now? Will be a question after a point. 2% down on DRL. Eicher Motors seeing a bit of pain. Maruti BEL. But this is a very, very positive kind of a chart. The India VIX. I'll just pull up the India VIX and the Nifty contributors very quickly before Alex comes in. India VIX about 0.5% down. No, sorry. India VIX 4% down. So it's showing a positive momentum there. Volatility is lower, and Nifty contributors is what I want to look at. No surprises. You're going to see, of course, Infosys there, TCS there. TCS, it's a good day for TCS considering the events of the last 24 hours. The fact that TCS is being bought into is good. ICICI Bank, Reliance Industries, so all the heavyweights there. The banks are not really participating, but they're not that down that they could hurt sentiment. So overall, a great start to the morning, Alex.
Yeah, you said it. And Tamanna, this needs to be built into. That's the big thing today, right? 0.5% gains. The question is, does that get sold into? Because let's face it, we have been in a sell on rise kind of a market over the course of the last several sessions. Let's take a look at the sectoral heat map just to drive home this point, and we're likely to see a lot of green on the screen reflecting what you're seeing on the benchmark. In fact, there's just one spot of red, and that might actually change while I'm speaking. There you go, it just did. Well, IT is up and about 2.6% or thereabouts, and that hopefully will hold through the rest of the session. We'll talk about a few of the smaller cap IT names. You already saw how the frontline IT companies are performing. They're in the top line. Metal is something that we also pointed out to you this morning. Steel companies are looking good in terms of fundamentals, and there are various other updates for the base metal pack as well. Up and about. Realty is bouncing back from the drubbing that it took in trade yesterday. This is a rebound trade that is taking place, about 0.75% or so for the realty pack. CPSE is also doing okay. Mid cap is up and about. Small cap is up about 0.7%. It looks like a positive start. So let's talk about individual stocks now, and a few significant updates. And I wonder whether this kind of a good mood is reflecting in some of the negative updates that you've seen also. Worry Energies and Premier. Let's pull those two up and know indeed that isn't the case. And this is likely on the back of the US increase in tariffs on solar PV modules. But remember, Parag Bhai actually pointed out to you just a short while back that Premier does not export these to the US. And so this is possibly something else that is at play. We'll have to get some clarity from the company as well. But both these stocks taking it on the chin today. IRFC reacting to the OFS price, 4.5% discount to the closing from yesterday, and this was expected, 3.7% or thereabouts. Again, the fundamental view is that maybe on the valuations it's not as attractive as the price might suggest. So watch out for that as well. On the earnings front, Schaeffler looked like it was going to have a pretty strong start. It is in fact continuing to do so, 5% uptick on the back of pretty strong numbers in the third quarter. IT stocks, and I want to pull up some of the broader market stocks, right? So not small caps by any stretch of the imagination, but something like a Persistent, Coforge, Oracle Finance, all doing particularly well because they had been sold into quite substantially. Those mutual funds that had quite a bit of this, particularly Persistent Systems, losing quite a bit of ground, they'll be in the green today. RVNL as well as HG Infra reacting to order wins. RVNL has actually slipped into the red, down about 0.4%, but HG Infra, tell you what, this is arguably one of the stocks of the morning because it's reacting to that 1,582 crore order, very substantial order win there. Sami Hotel has gotten approval for its second hotel in Bengaluru, and it's up at about 200 plus room hotel, so its capacity addition all the way for this entire pack. Hospitality is in focus, and we'll talk about that in some more detail. But I wonder, Hiral, whether there are any more stocks from the broader markets that stand out in terms of gainers or losers.
One stock that's coming to my radar is a Star Health right now. Pull up that one on the screens. A little over 6% is the kind of up move that you're seeing on this one. Birla Soft is seeing some strong moves as well. Others, you have Alex, who's already mentioned it, but SpiceJet continues to see some bit of pressure in today's session. But Star Health, Birla Soft, Kush, any views from a technical perspective? Because today there is some buying interest.
There is, and Star Health, there is resistance around 485 mark, not been able to take out, has seen rejection at higher levels. So yeah, I would actually look at this as a profit booking opportunity on Star Health. A lot of IT names, a lot of them, in fact, practically all of them, correct, including Birla Soft, are seeing that uptick from those oversold territories. So yes, if you have a position, if you were brave enough to create a position, when the stocks were falling, I would now suggest that, you continue to hold on to them, because if this were to continue in a slightly elongated short covering rally, then too you would have at least about 3 to 5% or more of upsides on some of these names. So yes, you should continue holding on to Birla Soft if you had a position. 371, that's your stop loss. Do you go out and create? Not now. You've already seen about anywhere from 1 to 5% kind of an uptick on some of these names. So I won't create positions right now, but if I had, I would continue to hold with days low as stop losses.
Okay, I want a quick take from Chandan. Chandan, this is a strong start. I want a nifty call from you. Are we looking like we can sustain?
Yeah, it seems that market is likely to sustain because we have noticed that absence of buying is visible, but sustained buying interest at lower level is clearly supporting the market. And for me, the strong point is in last 8 to 9 days, market drifted below 25,400, but it never closed below the same. So I believe that is going to be a key trigger. One can keep the 25,400 as a trailing support, and I believe with this support, index has potential to head towards 25,900 to 26,000 marks.
Chandan, thank you so much for joining us this morning. Parag Bhai, Kush, always a pleasure, and see you back tomorrow. Hopefully, we still have those smiles on by the time you come back tomorrow on that show. Nirav Seth joining us, CEO, Institutional Equities, MK Global Financial Services. Nirav, what a good day to speak with you. We thought we must speak to you right after markets open, but even we didn't know which way it will go. So luckily, it's at least starting well. But I'm not going to get into the here and now with you. I'm going to ask you what you think about this whole SaaS apocalypse fear and Indian IT companies, because they have such an outsized impact on the Nifty. They seem to be dragging sentiment down with them. Are you in the camp that believes that they are being underestimated right now, the capabilities of these companies in the AI context?
No. I have a strong view that for the first time we are looking at a large sector getting disrupted. Please appreciate the fact that, so first of all, I'm an all-in believer in AI, right? So some trillions of dollars of market cap is being created abroad. Unfortunately, we are not a part of that ecosystem at all. And that means that a large part of the future profit pool is also going to shift to these companies, whether it's Meta, Facebook, you name it, and there'll be some stack of SLMs, and then eventually there'll be application players on top of that. So this is genuine, this is real. And one thing that we need to appreciate is that incremental innovations that happen in AI will be disruptive, non-linear, and exponential, right? At a very fundamental level, the way I look at IT services is that you're moving away from an OPEX model to a CAPEX model, and that is usually disinflationary. I have no great idea what can happen in FY26 and 27. I think we are using the peak employment and IT services, and it's very, very tough to change the business model. I am not going to take that call.
That argument, Nirav, and very good morning to you, Alex, here as well. It's not just the IT services companies, right? So the point that is being made is that they have plugins for the legal services, they have plugins for investment banking, they have plugins for wealth managers. So the question really is, how many sectors get disrupted in your opinion?
Yeah, so you need to be very careful, right? So I completely agree. It's not that I got all the answers. I think Make My Trip has lost about some 50-40% of the value because obviously what AI agents can do the ticketing itself. And the whole idea of the business model of, let's say, for example, a travel trip, if you want to call that, was that you access to consumer traffic. Now, if the traffic shifts away and, if AI bot is going to buy your ticket somewhere else, you need to question that. I was having a discussion with my team internally that this is going to happen in next 10 years, in our lifetime, that you will have, serious AI agents doing the teaching job, right? And which is 365 days a year, 24 hours a day, and customized. And those teachers will be better than any teachers that you've got. What happens to the business model of education institutions, right? So I don't have all the answers. I know that there are sectors that are going to get disrupted. The only thing I would look at right now is that are there any sectors which are the wrong side of this? I call it revolution. It is genuine. It will take time. There is no doubt about it, but it is very real and it's happening.
Nirav, good morning. Hiral on this side. So clearly, you do have an overweight, I think, in terms of IT. The bouts of correction that have come in and the kind of underperformance that we've seen right now, would you be using to add positions when it comes to IT as a sector, number one? And two, when you're talking about the ancillary plays as well, which would those sectors be?
So, the model portfolio is run by my strategist. And like I said, people have their own views. And I'm speaking for myself as the CEO of the company. You can call this a sales call if you want to call it. I caveated in the beginning by saying that if any sector gets disrupted, I don't focus on valuations. I don't even focus on being a contra, right? I'll just let it play out, and I'll once you get more incremental data, we can take a call. I don't see a reason for any sharp pullback. You will have these cyclical buy-ups. So this is not fear. This is something real. And we need to be careful about that. And this has been happening for some time. Please understand that if you look at the last 2 years and if you look at the CC growth rate, right, of the Indian IT services, either in Europe or in US, it significantly underperformed their long-term averages. And the general narrative was always about uncertainty. US macro is not doing well. US macro was firing all the while. Right? The GDP growth rates have been significantly ahead of expectations. It never percolated to IT spending. And there's a question that you want to ask. And now this is accelerating. So to answer your question, I am very happy to sit on the sidelines because I believe in the AI revolution. Sectors we'll have to, I'm not an expert, but we'll have to, we are very, very careful about this. And we are doing a lot of work to try and figure out what all can get impacted. And please don't get me wrong. I'm not saying that the revenues are going to disappear, right? So, IT services are doing a great job. They understand the legalities, the complexities, stuff like that. The profit pool, it is disinflationary. Secondly, your profit pool, existing profit pool can compress. And then you also need to share with these LLM players if you are going to use their models. I don't know how this is going to play out. It's negative for sure.
Okay, one question apart from IT, because even though this is the biggest narrative and taking up all of our mind space, but there is so much more going on, including what's happening with tariffs. So from what we've heard from the State of the Union address, what has been happening, also this US duty on solar component manufacturers that we've seen, it's seeming like we have slid back to the times of arbitrary tariffs. Is that something which the street will find jittery?
Well, we have to live with the fact that we'll be tariffed, right? So far, the only positive is that if everyone else is getting tariffed, it doesn't matter. Export is all about relative competition. So you're not worse off than anyone else. I think that in some of the sectors, China has probably become more competitive because I understand that their effective tariffs have actually come down from what it was prior to last Friday. So there could be some sector-specific issues over there. But to me, the fact that you sort of are in an agreement with US trade is a big hurdle that you have crossed already, because that reflexivity in terms of negativity was playing out on rupee depreciation, inflation, monetary policy, and stuff like that, which also leads to capital outflows. We by and large arrested that, and that's a positive. So whether it's 15%, 16%, I don't lose my sleep over that.
Okay, Nirav, always a pleasure speaking with you. Thank you so much for coming in today and speaking with us. Markets seem to be holding on, and not at its highs, off its highs really on the Nifty so far, but holding on, looking fairly decent at this point. Now, AI execution took center stage for Happiest Minds Technologies in the third quarter. The company even plans to double down on AI investments by the end of FY27. Before we speak to the management on what their AI plans are, Jasmeet joins in with all the details.
Well, thank you for that. If you look at the overall AI plans of the company, we see that the Q3 marks a significant shift for the company, where they saw the AI investment turning into productivity, and the management expects that productivity to continue further. But management also makes a note that the company saw repeatable AI orders and a lot of AI-focused clientele deals when they saw in this particular quarter. In terms of the key revenue value, how much the AI revenue contributed, that's roughly around 50% jump in the revenue we saw in QOQ basis. When we talk about the AI revenue, it contributes nearly 4% of total revenue as of now, and the management expect it to double down going ahead in FY26, which is a wait and watch. If we look at the Q3 number, Q3 did see a healthy expansion in terms of margins, and management also remains very focused in terms of the capex plan which they do regarding the AI.
Okay, Joseph Anantaraju, co-chairman and CEO of Happiest Minds, joining in. Mr. Anantaraju, thank you so much for your time with us. And, ordinarily we would have spoken more just about your company, but allow me to start with a broader industry view, just in light of what we're seeing right now. And I know it's not correct to paint every company in this space in the same brush. So having said that, do you think that there is enough catch-up that Indian IT companies are able to do? We've had varied voices on the channel since morning, and one of them saying that we seem to have missed the AI bandwagon.
If you ask me, thanks for having me, first of all. But if you ask me, I think the whole potential of AI is just getting unlocked, in my view. And, even when we did our last, after the results, the meetings that we did, the point we were trying to make is that, with AI and agentic AI, some of the initiatives and needs that companies had that they couldn't do earlier. If you look at just modernization, if you look at a lot of the tech debt that they have, if you look at some of the legacy applications that they were not, enterprise are not able to re-architect and utilize them well, to leverage the data, all of that will be possible with AI. So we believe that there's a huge opportunity. There is going to be, demands from customers in terms of delivering software faster, productivity enhancements. So I think that's fair game, but there is enough out there for the Indian IT industry to lead to the next phase of growth, is our belief. Yeah.
Mr. Anantaraju, Alex here, and good morning to you. And
sure,
you answered that quite well, but I'm just wondering, in an age where the plugins that are announced by one particular entity that is maybe at the cutting edge of artificial intelligence technology, is causing flutters across the world, not just here in India. And the updates come through that there is partnership that is on the cards. And so anytime that takes place, there is an upward movement in stock prices. Is that the next way to go, where you have a partnership? If you can't beat him, you join him, and software as a service it changes the way that things are done. How do you see those partnerships panning out?
Sure. See, the partnership is a formalization of actually leveraging some of the technology and tools that these companies provide. For instance, if you look at OpenAI or Anthropic, we've been using Cloud Coworkers, we've been using Copilot, we've been using Gemini to help our customers with their software, both on the software development lifecycle, as well as embedding some of these capabilities into their products in terms of agents and taking an agentic AI approach. But once you have a partnership, you probably will have a little bit more of access to the technology, a little early access to technology, and you'll be able to get help maybe in the pre-sales. And we've done that with Microsoft. We have very good partnership going with Microsoft and with Google on both Gemini and on OpenAI, ChatGPT. We've been using Claude, as I've said, in quite a few of our customers. We're also looking at some new age companies that have these agentic AI frameworks that can be used to quickly spin up agents, and deliver for our customers. So I believe that Alliance helps, but building capability on these technologies, on these frameworks and platforms, and taking it to our customers is equally important.
Okay, so that's a good point. I'm just wondering that with these, and you've already said that you've got tie-ups and you've got partnerships, you're utilizing certain technologies as well. I'm just wondering whether that change in the way that business is done will affect the bottom line in the way that operations affect financials as well. Because ultimately, one would assume, hypothetically, that you won't have the need for as large a workforce in certain services that you offer than you did earlier. And so I'm wondering whether that happens incrementally or whether that is something that you could see as early as the first quarter, the fourth quarter of this year.
So if you look at it, Alex, it depends on the quantum of work that you get and the amount of business that you're able to get. If you're able to get enough business, the productivity enhancement that you get out of it, you should be able to defray it. So that's one point that we need to keep in mind. How much of new work, the legacy modernization, etc., that I talked about, how much of that business that each company would be able to get. The second point, from a margin and a revenue standpoint, is when you and this is something that we are internally in discussion, and I'm sure all our peers are in, that the productivity enhancements that we give, how do we capture some of that value? Because that value has to be shared with the customer, and there is fixed price projects into which you can bake in some of these productivity enhancements and price it in. You also have managed services where you can optimize the effort required and therefore capture some of the value. And the third part is a little bit more difficult. We are looking at is how do you look at some outcome-based pricing? So that again, where we can capture some of the value created by leveraging some of these tools and the productivity enhancement that they give and the additional benefit that gets created in the overall software lifecycle. So we'll have to look at it from all of these three angles. But from an individual company perspective, it depends how much of this business you're able to generate where you can leverage these tools.
Interesting point, and I would want to take it over from there, Mr. Anant Raju, is the margin evolution, because AI services will command higher pricing, as we were talking about it right now.
Yeah.
But investments are also pretty heavy on this angle. So there will be a short-term impact on margins. But when do you expect the AI business unit for a company like yours to reach that steady profitability level, number one? And two, when you're talking about the generative AI business services and the proprietary IP strategy, where does the Gen AI Research Companion fit into your overall long-term goal of hitting that $50 million AI-led revenue mark?
Sure. So, when you talk about the margins, Hiral, I want to break it up into two, right? One, you have the investments that you make in terms of training people, upskilling them, and those things. Second is on the tool front, which is probably also what you were referring to when you said you use their LLMs. As of now, if you really look at the pricing of some of these, whether it's Cloud Code or Copilot and others, the cost is not that high, and therefore the benefit you get from productivity enhancement far outweighs this. So as long as you're able to capture this value in terms of one of the three pricing constructs that I talked about, it will actually add to the margin. It won't detract from the margin. And what we're seeing in our GenAI business unit is that the overall price that we are able to command is 25% higher than what we get for other digital services, which more than makes up, because the utilization of that business unit is on the lower side, and we want to make sure that we have that we're doing enough internal work, we have people available. So it's a deliberate approach that we've taken. So I believe that we'll be able to manage the margins. If you saw the previous quarter, we did have an uptick in our margins. On the AI platforms or solutions, I want to break it up into two, right? One is we are creating a few platforms ourselves that are agentic AI, that have agents built into them, that take an agentic AI architecture, whether it's our banking platform, Artha, or our insurance in a box, and the education platform, which is still in a build phase.
Any headcount cut that you will have to implement as a result of these
No,
adoptions?
actually, we continue to hire quite aggressively, and if you saw the results we delivered for Q3 and reported, there was a net headcount increase. And based on the hiring that we're doing for Q4 as well, when we report our results, I'm confident that there will be a net headcount increase. So we're not looking at really a decrease in headcount, net headcount.
Okay. Thank you so much for speaking with us, Mr. Anantaraju. Really nice to have you here and explain what's happening. And it's good to see Indian companies also looking confident, even as people are writing off their futures. Chalet Hotels has announced a 633 crore investment to develop a 330-room hotel in Hyderabad with a completion targeted by FY29. Mahima is joining in with the details and a quick setup before we speak with Shwetang Singh, the Executive Director at Chalet.
Right, Tamanna, so as you rightly mentioned, that's a recent development coming in from Chalet Hotels. A 330-room hotel in Hyderabad is what they plan to open, and the investment that they're going to put is around 632 odd crores, and this is going to be a 36,225 square feet hotel, which is going to be completed by FY29, and this is in line with the investment and expansion strategy of the company. Now, just to give viewers a brief about how Q3 panned out for them, healthy growth in terms of revenue as well as EBITDA. Hospitality business did drive robust performance, strong traction across key operation metrics as well, and double-digit revenue per available room expansion was also supported by increase in average room rate. Now, this is where the entire industry is actually concerned with, right? I was reading reports yesterday, and the common trend that we've been observing is that since the past 2 years, occupancies overall in the industry have remained subdued, but ARR is what is actually leading the top line growth. In terms of operation highlights for Chalet specifically, occupancy fell by around 230 basis points YOY basis to that 68%. This was largely impacted by new room additions in Bangalore and Pune, and 12% RevPAR growth was driven by a 16% growth in average room rate. So RevPAR basically stands for revenue available per room. So this is the overall view of how, of course, the new addition that they're making and how Q3 has panned out. The key question will be that when does the industry actually expect occupancies to pick up and take over the ARR growth and probably, make some addition to the top line growth as well for these companies?
Thank you so much, Mahima, for that. This actually puts things to perspective that the growth for the hotel industry is coming in from a ARR increase versus the occupancy. And to see the kind of expansions that all of the hotel companies are looking at, this should be one of the key questions we should be talking about as well. And Shwetank Singh, Executive Director at Chalet Hotels, joins in. Shwetank, good morning. Hiral on this side. Welcome to the show, and it's always a pleasure to speak to you. You know, I mean, we're talking about
Thank you.
Always a pleasure. We're talking about the Hyderabad expansion that they are looking at, a 330-room hotel. My question is, this will introduce India's first Ritz-Carlton in Hyderabad, right? So it is a competitive landscape that you're watching out for. But with this kind of expansion, which is really massive, and your hotel growth in terms of top line is coming in through ARR versus occupancy, how would you want to put this into perspective?
Look, thank you. Good morning, and thank you for having me on the show. This ARR versus occupancy growth is not. It's the standard, almost a standard operating procedure for the hospitality industry. If you look at any mature markets outside India as well. And actually, ARR growth is a very healthy growth because when you grow on ARR, it gives you a chance to actually improve your margins overall. Of course, occupancy brings in more occupied rooms and therefore more sort of variable cost that hits the business. So ARR growth is a very healthy growth. As far as the industry is concerned, the occupancies will typically any mature markets tends to taper out around 70 and 75%. So that's considered a very healthy occupancy. And from there on, ARR take over and sort of builds on that. Coming to the bigger news here, our big announcement has been a Ritz-Carlton, a 333-room hotel in the luxury space, and that's totally in line with our stated development strategy. We want to continue to be in big markets, in big boxes ahead of the infrastructure curve. And actually, we are doing this with Mindspace. Mindspace is a sister concern within the group. And what they do is that they provide us very good leading indicators. Business is moving. We have over 13 million square foot of commercial space there within that Mindspace region. And therefore, it only warranted another hotel in the luxury space. The Hyderabad market has been on fire for a while and continues to so as more GCC businesses and international businesses move there. This one comes at an investment of about 600 odd crores. And on top of that, it is going to be a leased property. So we will be, the Mindspace company will be handing over a leased warm shell to us at a cost of approximately 300 crores. So if you see overall, the investment in the hotel is circa 900 crores, which means less than 3 crores a key, which is a very healthy number in the luxury space. It will, of course, be Ritz-Carlton, as you said, and that's something that's very exciting for Chalet because it marks our first entry into true luxury. And as a business, we are looking at premiumization of all our products as a central theme. So more and more, you will see us inching that segment because we believe that's where the growth resides today.
Shwetank, very interesting point that you're raising, and good morning to you, Alex here. I'm wondering what that mix will look like and how you're going to bolster that, right? Because you have an existing network which you're bolstering quite significantly. Will the incremental additions primarily focus on the luxury segment, and therefore by the end of FY27, for example, or maybe even if you talk about the next 3 years, culminating in FY29, will that be a shift that you see that is very dramatic in terms of the mix in the properties that you offer?
Not necessarily. We'll still do what's right for each location, and Hyderabad demanded a luxury segment. But if you see at the brand that we have launched, the Thiva, is in the upper upscale segment, and we have been sort of tinkering with looking at some kind of a soft brand association. And we will, if we go down that path, then we would like to use that path to sort of pull the brand up into the premium segment, and that's the direction we want to take. So in general, yes, that's the direction we are inching towards. It's difficult to give you a sort of number as to where it is heading to, but I can tell you that a majority of the pipeline, both announced and unannounced, will be...
Will be what? We lost that last bit.
Will be heading in that direction. Sorry, will be heading in that direction overall.
Be heading in that direction. Okay, so let's talk about, Shwetank, the pipeline, right? Because I know that every quarter we speak to you, there is a new update. So therefore, it's important for your investors to understand where things stand right now. What is the pipeline of additions that you will have, and will there also be a strategy of acquisitions that you make?
Yeah, excellent question. Actually, we have a total announced pipeline before we made this announcement of about 1,200 odd keys and about 0.9 million square foot of office space. This adds 133 keys to the overall number, taking number to say circa 1,500 keys in the IT space. The 0.9 million square foot of commercial stays as it is of now. Yes, we are in very exciting times, and we will continue to look at expansion both through the greenfield and the brownfield route. We like both. But as a principle, what we would like to build where we can, because we feel that we can bring in markets where we will find it difficult to build, where we will continue to do the acquisition route of operating hotels or brownfield assets. Udaipur being a case in point, where we have taken over a hotel which we will then continue to which will then refurb and bring back to the market. So it will be a mix of both strategies.
Okay, so a mix of both. Shwetank, a quick one when it comes to the fourth quarter. A lot of conversations are indicating that probably January was slightly weak because of a weak wedding season. Now, to add to that, if you have to look at the month of February, specifically Delhi, on the back of the India AI Summit, expectation is that your ARR is going to jump. And not only for you, the entire hotel industry, with the kind of occupancies and room rates that were going around over there. If you have to club both of these in, what will that Q4 look like?
No, I mean, Q4 is not looking as good as Q3 was, but okay. I can tell you that it's still going to be a very healthy growth. January was disappointing on several counts, as you said, one being socials. Mumbai went through an election and sort of always messes with the business locations, but helps with the leisure locations. And that's exactly what we experienced as well. But overall, the quarter will come out in double digits. That much I can tell you now. And it'll be still be a very strong quarter for the industry as well as for us.
Shwetank Singh, MD and CEO, Chalet Hotels, thank you so much for joining in this morning and talking about the space. Truly an interesting one. I think more and more, I must say, guys, I'm saying it's important to take a deeper look at brick and mortar, real life, tangible businesses, which may not be impacted to a certain extent. Of course, if you have a total economic meltdown because of AI and lots of jobs getting cut and the whole MICE space getting impacted, that's a different question. But think about core infra.
Or products that you cannot replace. Automotive, for example, you can't replace a truck with artificial intelligence, and that's proven by the numbers.
Your core infra, as Tamanna is mentioning, your consumption, which is FMCG that Parag Bhai has been reiterating right now.
You have to brush your teeth. Even robots, you buy toothpaste.
So I think these are sectors which will be somewhere not impacted to an extent from a growth perspective.
Could be a defensive look you need to, and that's why we were looking at the hotel space as well. But let's get a little deeper. India's hotel sector has posted a slower than usual performance in the December quarter. Despite this being a seasonally strong period, growth was largely led by higher room rates. Mahima joins in with more details. Mahima, what's worked for them?
Right, Tamanna, so as you rightly mentioned, this quarter, and this has been the story for the last couple of quarters as well, right? Because occupancies in the past 2 odd years have really not picked up. But the range of occupancy has been around that 65 to 70 odd %, and average room rate is what actually is leading to the top line growth for a lot of these hotels. So the question really here is that what can these companies do to probably boost that occupancy level? Of course, the global average of occupancy is anywhere between that 75 odd %. What can companies do to bring it to that 75% level from that 65 to 70 odd range right now? In terms of how Q3 has panned out for both average room rate as well as occupancies, we can see that the range of growth for all of these companies has been from that 7 to almost 17% mark in terms of average room rate increase. But at the same time, occupancies have dipped, except for IHCL, which has seen a growth of around 1.2% in their occupancies versus a downtake of around 82 basis points for Lemon Tree, around 2. 0.3% for Chalet. Ventive was almost flat and 100 basis points for something like an EIH. Now, apart from this, the overall revenue per available room, because of average room rate going up, has seen a good growth. But Q3 performance overall, the outperformance, overall, if you take a look at how the outperformance in RevPAR growth was, Leela as well as Brigade and Juniper saw growth anywhere between 14 to 20%. ITC, Chalet, Sami, EIH saw growth between 11 to 13%, and least growth was seen in IHCL, Lemon Tree as well as Spark Hotels between that 7 to 9 odd percent. In terms of the top performing companies overall, Leela Palace Hotel saw 23% growth year on year basis, ITC a 21% growth, Ventive Hospitality a 28% growth, largely driven by pickup in the Pune region is what they saw. In terms of other trends, margins were also impacted this quarter because of two reasons. Firstly, provision of the labor code, and second, the GST ITC law change also did see some impact on margins as well as EBITDA. And management, however, also did continue to reprice their assets due to persistent demand and supply mismatch. So that is one thing that also the industry needs to consider right now in terms of how they can take the occupancy levels up from here on. Plus, corporate actions have also intensified. Two developments, major developments, demerging for Lemon Tree, demerging their asset-heavy arm with Warburg Pincus, where Warburg Pincus will be investing, that is Fleur Hotels, and IHCL also invested in Bridge Hospitality. Lastly, in terms of what brokerages are making of all of this, Nuvama has said that January was weak, but February, March will look strong. That is what they're expecting with how wedding season will pick up in these 2 months. Future growth will hinge on average room rate, as occupancies have peaked is what they're suggesting. But going forward, if there are acquisitions being made, that could improve occupancies going forward. So that's something that both Jefferies as well as Nuvama is eyeing. Their top pick right now in the hotel space is Lemon Tree. Jefferies has said that the hotel industry in India is currently kind of completing year of its upcycle, and we'll have to wait and watch out for as to how things pan out from here on. And as per industry data, the overall revenue per available room growth in Jan slowed to around 5%, and their pecking order is IHCL is the top priority, then ITC, and then Chalet. So this is the overall view of what's happening in the hotel industry right now.
Okay, from hotels to pharmaceuticals, we talked about why Dr. Reddy's is in pain today. Let's see if there's been some recovery. Well, a bit of recovery, I would say, off its lows at least, but still about 14, 15 rupees down. Novo Nordisk is slashing its US list price of its blockbuster drugs, Ozempic and Wegovy, by as much as 50% from early 2027. Varsha joining in to tell us why this is tough news for Dr. Reddy's.
Well, all other Indian pharma companies are not reacting to this news because Novo Nordisk will eventually launch their generic, the semaglutide in India. But only Dr. Reddy is reacting because of the Canadian market. Now, first on the news, Novo Nordisk will cut list prices of its blockbuster weight loss drug up to 50%, and the similar price cuts can be seen in Canada and Brazil markets also. Wegovy, Ozempic are the drugs which will be impacted. Now, the price cut aligns with the lower Medicare prices coming into effect next year, which applies under US Federal Medicine Health Plans, which is a part of broader US drug pricing reforms. Now, why only Dr. Reddy's is impacted from this news? Because if you see, the patent of semaglutide has already expired in Canada, and Dr. Reddy's has a first mover advantage in the Canadian market. They aim to launch generic semaglutide in Canada once Health Canada clears its file, and management has guided for a launch window between Feb to May 2026. Semaglutide IP has lapsed early in Canada in Jan 2026, which makes it one of the earlier Western market for generics, and hence we are seeing pain in Dr. Reddy's, considering the first mover advantage that the Dr. Reddy's will have in Canada market. And if the price cut follows in Canada, of course there will be a margin pressure for Dr. Reddy's.
Okay, now tech stocks is also what is in focus this morning, showing a smart rebound. A couple of reasons, good notes this morning saying that it's not as bad as people think, isn't it, Jasmine? That's aiding sentiment.
Well, Tamanna, thank you for that. As rightly said, we see a rebound coming in overall tech sector. Well, this thing comes on the back of that narrative change, where initially we thought that the AI will replace software companies, but now the street is expecting that AI will just be an enhancer and software companies will stay. And this positive momentum has not just led the Indian IT in an up move in trade today, but also the global tech firms saw a positive up move last night in trade. Now, in terms of what exactly has changed is basically the overall partnership that Anthropic AI has been doing with a lot of SaaS companies. And last time when they collaborated with Infosys, they also made a note that there's a huge gap between the AI models and what exactly execution works on. And this is being helped by the SaaS companies, and that's why they had a collaboration with Infosys. While multiple SaaS company collaboration is something that's leading the overall positive up move in the stock. If you look at the overall performance of Nifty IT, it has been down over about 17% in trade in February itself, and we see huge FI outflow as well.
Jasmeet, we'll come back to you. You know, while IT stocks are winners, there are others that are getting shocked today, and this is from a fresh announcement of 126% preliminary duty on solar cells and modules from India. This is aimed at shielding US solar manufacturers with cheap imports chipping away at local production. That's what they're saying. When they're talking about cheap imports, they're talking about including imports coming in from India. Let me go across to Wari's Abhishek Parikh. He's the group head finance. Abhishek, it's almost like deja vu. It's nearly, I think 10, 11 months ago, we were having the same conversation when the first set of tariffs had come. And then we thought we had a deal, and then we were back to square one. Is that the case? Because, you know, you're seeing that in some worry from investors. What's the extent of impact?
First of all, good morning. And I really resonate with what you said, deja vu. But let me tell you one thing. Generally, deja vu is an overhang overnight. But for us, it has been happening for the last 10, 12 months of time. So what we as an organization realized that in the new realities of the world, we have to keep working towards our supply chain resilience. We have to keep looking out for alternate supply chain solutions. And that's what the result is that Wari today has 1.6 gigawatt US capacity. We acquired 1 gigawatt 2 quarters back, and another 1.6 gigawatt of new capacity of module is under construction in the US. So by and large, 4.2 gigawatt capacity we shall have early next year. So that puts us in a very sweet spot, given the fact that any sort of import restrictions or tariffs really does not disrupt the local manufacturing in the US. And that's what has insulated Wari so far. And I think our strategy continues from here.
And on that puts you in a sweet spot next year. But you're also saying you're insulated at this point. As I understand it, 50% of your order book is from your US sales. That's 15 to 20% of what you sell. That gets impacted immediately, right? While your US-based manufacturing will come in and mitigate, that will take time to come on and replace everything you're selling right now.
So, okay, there are basically two parts of it. One is local manufacturing in US, which is already up and live. We are already serving majority of our orders of US market from our US facility only. When you look at the order book...
Sorry. To what extent of your US orders are being served by your US manufacturing facility at this point?
More than 70-75%.
Okay.
More than 3/4. So practically majority of anyways it was being served from US. Having said so, it does not mean that we are not going to export from India. By the way, in the tariff life of last 10, 11 months, we have continued to export, and we continue to keep the export volumes as similar as it was last couple of years. So our export volumes have not come down because of the tariff, because in the regulations, what really matters is how is your supply chain distributed for entire upstream products. When we manufacture panel in India and we are getting sell from those countries which are not yet tariff-free in the US or which are insulated from these tariffs, you continue to export at the same rate at which those countries are being taxed out. So fundamentally, last 1 year also, we have been paying the regular tax of 15%, 20% that was normal and non-import of any panel from any country, despite the 50% tariffs on the Indian markets.
Okay. Abhishek, hi. Alex here. So I just want to take that point forward a little bit, right? So if you're saying 70% of US sales are catered to by local production there, which implies that 30% impact is there. So in certain other sectors, and I wonder if this took place for you as well, which is that when tariffs increase, your local buyers or the US-based buyers of these products either adjust time frames or they share the burden. Is that going to take place here where, for example, if you are going to add capacity and that starts, in April, will you push some of these deliveries to the start of the first quarter?
So irrespective of the timelines of the new lines in US going live, our exports from India shall continue to happen. So as we speak, we are still exporting export consignments from our factories all across India towards the US markets because we were not yet utilizing the local manufactured cells for the US exports, which again insulates us from these kind of new duties which have been announced yesterday.
So help me understand that. So you're saying that, let me be absolutely clear. So out of 100 units sold in the US, currently 70 you're saying are manufactured and sold in the US itself. 30 are what you're selling as exports from India. 126% is now the levy of tariff on those exports from India. Can you explain your previous sentence in the context of what I have just asked?
Sure. So while you said that majority of shipments